This is the Lulich Corner. I'm Jordan Lulich with Lulich Attorneys, and today we've got the pleasure with sitting down with Amy Speak. Amy, thank you so much for joining us, and why don't you tell us a little bit about yourself?
Sure. Thank you so much, Jordan, for having me first off. I've been a residential lender for over 24 years. I graduated from the University of Florida. I grew up in Palm City.
Gators?
Yeah, I know. Don't even start with
man.
me. Don't make me do the chomp.
Hence your dress. I know.
I grew up in Martin County, so pretty close
Yep.
nearby, and graduated from the University of Florida and started doing mortgages right away.
Okay. So you've been doing this for a while, and I think safe to say you can call yourself a native and a local.
Sure.
So let's kind of dive into mortgages, because that's what we're here to talk about, right? I'm sure you love talking about mortgages, and you could probably talk all day long about it. That's what you do anyway. So when people are thinking about venturing to make a purchase, sometimes sellers look for a pre-approval letter, right?
Yes.
So and then we also hear this term that's thrown around, which is pre-qualification,
Sure.
right? So isn't pre-qualification pre-approval, or what's the difference?
So a pre-approval is much stronger and is
Okay.
going to give you a much stronger chance of getting the house if you're pre-approved versus pre-qualified. So a pre-approval means that the lender has actually viewed documents, the income and the assets, and not just taken the borrower's word for it. So if they're self-employed and they say they make $200,000 a year, for a pre-approval, I'm going to say, let me see those tax returns so I can take a peek at them and make sure that that's their net and not the gross amount.
It's actually saying what they're saying is true. So it's
Exactly.
just verification.
Yes.
So when one's getting pre-approved, are there some things that one shouldn't do before
sure.
they get pre-approved
For
or
sure.
after they get pre-approved?
Yeah, well, so don't do anything crazy. Don't go out and change your job or quit your job. I've had that happen before. Don't go buy a brand new car. You know, if you've got a car that's getting you from point A to point B and you don't have a car loan, don't go get a new car with a car loan, because that's just going to take away from your buying power. Don't close credit cards. People think that, I'm going to go pay off this credit card and close it. Don't, because that could actually decrease your credit score. Don't deposit large sums of cash. A couple $100 here or there. Usually the guide is 50% or more of your monthly income. We have to source those deposits. So if you make $10,000 a month and you put in $6,000, I'm going to have to ask you where it came from. And I'm not being nosy. It's just part of the deal. Don't borrow money from other people. Again, that's large deposits. Please don't go transferring. I don't know why everybody does this, but they'll have 4 accounts, and then all of a sudden they start transferring money all around, and we have to go on a scavenger hunt.
Don't do that.
Try to just leave your stuff where it's at, and don't do anything to change your picture at the moment. Then once we talk, then I can counsel you how to adjust what you need to.
Interesting. That's good to know.
Yeah.
So when people are getting pre-approved or pre-qualified, right? I know that one of the things that lenders look at are debt-to-income ratios, right? And there's different debt-to-income ratios for, an FHA, for conventional. So what is a debt-to-income ratio, and what's a healthy debt-to-income ratio?
Great question. So debt to income, otherwise known as DTI. So when your lender throws out DTI, you'll sound real smart and know what they're talking about. It's basically your current liabilities, such as that are on your credit report, credit cards, student loans, car payments, in addition to any other obligated debt like alimony, child support, divided by your gross income. So for an example, if you make $10,000, I use it for easy math. You make $10,000 a month. You have maybe a $500 car payment, $250 student loans, maybe $150 in minimum credit card payments. And let's say the new house is going to be $3,000. Your total debt would be about $3,900 divided by the $10,000. So you're at 39%, which is a great debt to income. Government loans like FHA and VA, they will allow a little higher, up to 55% debt to income. But usually 43 to 45 is where you want to try and be for a conventional loan or portfolio loan.
So conventional versus portfolio. So what's the difference between the two?
Sure. So there's conventional then there's government loans, and then there's also portfolio loans.
Okay.
So a conventional loan would be the standard loan, like the Fannie Mae, Freddie Mac that you hear all over the news. The government loans would be the USDA, VA, FHA.
Okay.
And then the portfolio loan is a loan that an in-house lender, like SouthState, we'll talk about that in a minute, products that we offer that are our money that we're lending out.
Okay.
So they all follow different guidelines.
So is one better than the other?
Really? No. It just matters.
Okay.
So if someone calls me, we're going to look at the credit score first. We're going to look at their available cash, and we're going to put them into the right product. So that's why you want to find a seasoned lender who knows all the different programs, because someone might come to me and think they want an FHA loan, but once I look at their credit, their debt to income, and their whole picture, I'm going to say, no, you don't want to go FHA. You probably want to go conventional.
So it depends on one's situation and what one's economic strength or resources that they have.
Yes.
That's kind of factored into making that decision. And I know like some borrowers, they are required to get PMI, right? So what is PMI and how do you avoid PMI?
Sure. So PMI is private mortgage insurance, another acronym. You'll sound like you know what you're talking
DTI,
about.
PMI.
Yeah, I know.
Look at this cool cat over here.
Yeah. So PMI gets a bad name sometimes, and it's really nothing terrible. Obviously, if you have the 20% to put down, great. You don't have to pay the PMI.
Yeah.
But I wouldn't allow that to stop you from buying a house. So PMI is based off of your credit score, your occupancy, and the loan to value.
Okay.
So the higher your credit score, great.
Okay.
The lower the loan to value, great. And whether it's a primary, a second home, or an investment property will also go into the factor of calculation. Now, having said that, you can have the PMI removed at 80%, but at 78% it's removed automatically. So if you bought a house for $100,000 and you borrowed $90,000, once you get to $78,000, it's automatically removed.
Now, is that automatic, or is it's based upon the purchase price at the time that you purchased the property?
The purchase price.
So what happens if the property appreciates in value?
So every lender is different, but the standard rule is after 2 years and perfect payments, you can't be delinquent or have a bunch of delinquencies, you can request it to be removed. And if the value has gone up, so let's say you bought a house for $100 and it was worth $150 2 years later, you can get an appraisal and likely get it removed. There are certain restrictions. The other thing is very important to know is the FHA and conventional PMI is different.
Okay.
That was conventional. On FHA, that is not the case. It used to be, but I can't remember what year it changed. Many years ago, FHA started implementing where it was 11 years to life of loan. So you'd have to refinance to get out of an FHA PMI. Now, another thing on the FHA PMI is there's an upfront MIP. So, for example, if you were borrowing $250,000, the upfront MIP is 1.75, so you're going to add $4,375 to
your closing
the
costs?
Loan amount or the closing costs. Either you can pay it at closing or work it into the loan.
So one of the things, you and I have talked about this, previously, but one of the things we're seeing is builders, new construction builders. They're a builder, they're a title company, they're a lender, right? They do it all, right? And so they advertise these offers, they advertise these deals where if you buy a home, they'll give you a lower interest rate, or they'll give you $15,000 towards your closing cost, or they want you to use their people. So what would you say to the people who are considering new construction and who are offered these types of deals? Is it a no-brainer? Do they just take it, or
no?
What do you think? What's your
in my opinion, I'm a very honest and transparent lender. If you were to come to me, and what I usually tell the client is to do your due diligence. Get what they have to offer, bring it to me, let me compare. I have seen sometimes where, yes, it is a benefit to the client. And I'm like, go with the ABC lender. Especially when they're a very well-qualified borrower. Remember, a lot of the lenders that work for the builders, I'm not going to call them paper pushers, but they're not seasoned lenders. They're younger lenders or not as experienced lenders. They don't have to go out and work for their deals.
They just come to them,
Yes. So it's a little bit different.
So more complex deal, maybe a little bit more challenging?
Yes,
Is that what you're
right. And they might not fit. Like we have some programs that those lenders won't offer. And
Right.
we're going to talk about those portfolio. But the most important thing is do your due diligence, speak to a lender that you trust or maybe that you've been referred to by your lawyer, by your realtor, whatever, and let them compare apples to apples because a lot of the times the fees are just worked in. So as my mama always told me, nothing is free in this world. So
Good advice. So when one's trying to get pre-qualified or one's working and saying like, I want to buy a property, right? And they need to finance, what impact or what relevancy does job history come? Like, can you just start working and then in a month after you receive 2 W-2s get qualified? Or is there
Right.
like a requirement as far as how long you have to be working or the history of the jobs that you've actually held?
So think about it. The most important thing about a loan is we want to make sure for stability of income and that you're going to be able to repay us.
Yeah, makes
So
sense. Yeah.
The one circumstance that, yes, it's okay if you get a job tomorrow is let's say you just got out of college and
Okay.
you became a lawyer.
Okay.
You went to law school,
Yep.
you get your degree, and you get a great offer at Lulich Law Firm to be a lawyer.
Yeah.
I can count that salary right away
Okay.
because you just spent all those years getting your, or a nurse,
Yeah.
or a doctor. Anything where you have to get a degree or a
Specialty.
certification,
Specialized.
you'll have to show me that certification at the last 5 years, whatever you've been in school.
Sure.
But then as long as you're a salary, I can count you right away.
Okay.
Otherwise, you're going to want to have 2 years in the field.
2 years. Okay.
Now, it doesn't mean you have to be at the same employer, although that is obviously the best situation for job security.
So
but
like
if
an
you
independent contractor, is that what you're
that's
saying?
self-employed.
That's
So
self-employed.
self-employed, you would
Okay.
definitely want a 2-year history.
Okay.
There are some exceptions around that a lot of lenders don't know. But let's say you worked for a storage facility company. And then you bought that company.
Mm-hmm. Yeah.
And let's say you worked there for 5 years and you were the manager.
Yeah.
And then you bought it and you only have 1 full year of tax return.
Mm-hmm.
If I can show that 1 year you made more or greater than the year before as a W-2 employee, a lot of the times I can make that work as well because
Okay.
you're in the same field. But standard rule of thumb is 2 years self-employed.
But there's exceptions, it sounds
There's
like.
always exceptions, and that's, again, why you need a seasoned lender who knows the rules.
So seasoned lender is, you keep getting back to that
Experience.
the experienced lender, but what's your train of thought as far as, is a seasoned lender who's out of town just as good as a seasoned lender in town?
Good question. Local, I always believe, is better.
Yeah.
We live in a nice, small knit community here.
Yep.
We're so blessed.
I agree.
And I've lived here for 24 years. I was raised 2 counties south, so I am a wealth of information for the whole Treasure Coast. I know
Yep.
someone that does something of every trade. If you're working with an out-of-area lender, 1, they might not use local appraisers. 2, they might not know insurance companies or lawyers to hook you up with. I can never say use this person, but I'm almost every deal asked who would I recommend, and I give some names
Right.
of people I can trust to get the deal done. Just local's always better.
I
Plus,
always tell
the biggest
people-
thing is I think that my name on a pre-approval is much stronger than somebody from ABC that they don't know. So if there's multiple offers on a house, I can tell you many times the person has gotten the deal because my name is on the pre-approval.
Because you know the local realtors and you know
Yes.
the local professionals. I always tell clients that you could never place a value on the ability for using someone local and then going into their office and facing them if something happens, if there's an issue that results. Like, we can find you and we can
Yes.
find your office. We can see you in Publix. We
Yeah,
can see you in
Publix,
Walmart.
that's what I always say. I always say I don't
we can
want to
see
get
you in
bananas
Walmart.
thrown at me
Yeah.
at the Publix.
So I would say, like, as a local professional, we've almost got a greater level of accountability
responsibility.
and
Yes,
responsibility
yes.
because our clients are going to hold us accountable because we've got to face them when we go to Walmart or a Publix or wherever.
And you never
we
know
shop.
who's going to be your kid's next teacher or your
Right.
kid's next football coach. So
Yeah.
I treat everyone with respect.
Absolutely.
But it is definitely more accountability and responsibility when you're local.
Yeah,
So
I love it.
that's why I've
I
always
agree
worked
with
for a
you.
local bank.
Yeah.
I've never worked for a big mortgage company. I've always worked for a local bank.
I agree with you 100%. So to wrap it up, what does SouthState Bank offer that others don't offer?
Sure. It's the power of our portfolio. So
Okay.
since we are a local bank, we have our own money to lend. We're not just doing Fannie Mae and Freddie Mac and FHA and VA. We offer all of those, which is outstanding.
Yeah.
But we also are able to provide products that maybe have a little more common sense lending or that maybe don't meet the criteria exactly. We can bend a little bit to our own requirements. We have physician loans, construction perm loans, lot loans, my favorite, we have Buyer's Advantage, which is our 100% with no MI, 30-year fixed loan.
Yeah.
It's just, that's a CRA loan, a Community Reinvestment Act loan that we're able to offer.
Yeah.
And we also have some personal down payment assistance that comes from SouthState. It's $12,500. It can go towards down payment, closing costs, or prepaids, and it's forgivable after 5 years with no payments.
Okay.
So it's a
pretty
pretty amazing
cool.
program that can go hand in hand with our Buyer's Advantage or any of our other programs that it works with.
Okay. That's awesome. So you've got someone who might not qualify for that conventional or FHA or that VA. There's some other products and there's some other loans that they may look to SouthState for to get qualified for. That's good to know.
Yeah, our jumbo loans on the secondary market, I always tease, it's like getting a colonoscopy. I mean, getting a jumbo loan, the criteria is sometimes can be very laborsome.
Yeah.
And we have a portfolio with amazing jumbo products that are a little bit less painful.
Nice. So, Amy, how do people find you if they want to reach out to you?
Sure. You can call me at 772-473-9165 or text me, whatever is your preference. Or you can shoot me an email at aspeak@southstatebank.com.
All right. Well, this is the Lulich Corner. Amy, thank you so much for joining us, and we'll see you next time.
Thank you so much.